This six-step A-plus setup trading strategy I'm about to share is what made me a profitable trader. It was the first setup that made me earn my very first dollar in the trading industry, and it remains my most effective strategy to this day that brings me consistent profits. In this video, I'll walk you through each step of how to trade this setup, including a detailed breakdown of the trades I took with this setup, and by the end of this video, you will learn all you need to take your trading to the next level. I'm Z, and after 4 years of trading Forex, I've learned that many trading concepts are explained in overly complicated ways. That's why I'm here to break things down simply and clearly, just like I wish someone had done for me when I first started. This is educational content, not financial advice, so without any further ado, let's dive right in. An A-plus setup is a perfect trade opportunity that meets all the key criteria for a successful trade. Then a confluence is when different technical analysis methods all point to the same conclusion. Confluences don't appear 100 times a day. Trading is a game of probabilities. Price might go your way, and sometimes it might not. So looking for confluence in a trade setup is literally putting all possible odds in your favor. Where I come from, we have different ingredients for making various kinds of soups, and usually the soup will not bang if all of the necessary ingredients are missing. If all the necessary ingredients are not available, at least some should be available. And if all the ingredients are not there, guys, I'm good. I'm better off eating rice or maybe noodles. Let's say, for example, the price was going down and you saw a head and shoulders pattern. That simply cements your directional bias, giving you a confluence and confirmation that price is seriously heading down. As a trader, A-plus setup with confluence is important because it increases your confidence. Having a high-quality trade setup that is backed by confluence can boost a trader's confidence because when multiple factors align, the likelihood of the trade moving in your desired direction increases. Having this confluence all lined up in your chart helps to avoid that hesitation you feel when you want to click the buy or sell button on your MetaTrader. You know, when you have lost so much in trading, it kills your confidence as a trader. Whether you agree with me or not, that is just the truth. The next time you see a setup glaring at you in the face, you hesitate in fear because the trade might turn out to be a losing trade. But when you have all these confluences, it strengthens the conviction behind the trade, so you go ahead and place the freaking trade. Another importance of trading with confluence is that it gives you a better risk-to-reward ratio. An A-plus setup helps you to trade in areas where the potential reward outweighs the risk and where to properly place your stop loss. You know that all trades are not equal. There are some trades that you should only risk a little on, and there are some that you risk a little more on. When you have your confluence intact, you will literally know if you are to risk more or a little. One thing I have come to realize is that relying on A-plus setups with confluence builds this kind of discipline that most successful traders have. You will all agree with me on this, that most gurus are always focused on high-quality opportunities rather than chasing after every market movement. I think I have said this at the beginning. Let me just say it again in case I didn't. The truth is that you will not see all your confluence every time, but when you specifically have what you are looking for in the market, you will chillax, take a chill pill, and wait for it to show up before making any trading decisions. The problem is that most traders don't even know what they are looking for. No trading plan, no trading workflow, no nothing. These types of traders make profits today and give it back to the market the next day. So confluence are those technical factors that produce results over time in your course of trading. Personally, for me, my confluence is 6 factors. Number 1 is the market directional bias from the higher time frame. If the higher time frame says buy, all I'm looking for is buying opportunities. If the higher time frame says sell, I'm only looking for selling opportunities. I don't care what is happening on the lower time frame. Even if the lower time frame is breaking healthy structure contrary to my higher time frame bias, I simply don't care. So when I'm done identifying my directional bias, I look for the most recent and significant break of structure to the upside. If my bias is bearish, I look for the most recent break of structure to the downside. Once this is sorted out, go ahead and trace the demand zone that caused the break of structure. If it is bearish, I look for a supply zone that caused the break of structure. Then after that, I look for liquidity close to my demand zone that price will sweep before tapping into my zone. If you are still watching and don't understand liquidity and how it works, check out this video on my channel. It explains everything you need to know about liquidity. If price has liquidity close to my supply-demand zone, that's fine. But if it doesn't, I'll wait for price to engineer liquidity. But if price fails to engineer the liquidity and the other confluence is intact, I will take the trade, but I will risk a little. If you were paying attention, you would realize that I just used confluence to know that this trade is a low probability setup, and it means I'm going to risk a little. If I don't have my setup plan in order, I will think it is trading as usual and risk more than I should. Anyways, moving on. Another thing that is compulsory for me is FVG. I see FVG as a magnet that pulls price to a certain area. Funny enough, I personally know some traders that don't use FVG, like they don't care if they see it or not, and they're still profitably trading. That is why I initially said that confluence is something you have seen work out for you over time, or maybe something you have seen work over time when backtesting. While FVG is a must for me and many traders, it is not for many traders as well. So, back to what I was saying. Price must leave an imbalance close to my supply-demand, which gives me a strong conviction that my zone is valid. This next confluence is not really very common among traders, but it has saved me a lot from entering a fake breakout. The confluence is trading volume. Again, if you want to know more about it, the video is on my channel. You should check it out. A supply-demand zone might have FVG, which signifies that large institutions actually placed huge orders in that zone, but I need evidence to cement it. If the candlestick on price matches the trading volume, then my supply-demand is valid. For the breakout I talked about, if I see a breakout and I'm interested in trading it, I will match it with trading volume. And if they mismatch, best believe that 8 out of 10 times the breakout is false. A real breakout should match with the trading volume. Okay, so here is a trade example of my A+ setup with confluence. So, as you can see, price is heading up as my directional bias. Having identified the market direction, all I'm looking for is buying opportunities and buying opportunities alone. So, my next interest is to find the latest break of structure. If price didn't break structure, then I'm not interested. Price needs to tell me, okay, I'm seriously heading up by breaking structure to the upside. Having identified the recent BOS means break of structure, by the way. My next line of action is to look for the demand zone that caused the break of structure. A break of structure doesn't just emanate from nowhere. So my job at this point in time is to hunt the origin that made price to break structure. I find this origin and mark it out. Since price is bullish, this origin is called a demand zone. There is this slang that is common among traders. It goes like this: if you can't spot liquidity areas, you become the liquidity. The truth is, price works hand in hand with liquidity. Without liquidity, trading will be... I don't have a word to describe it, but liquidity is more like the fuel price needs to move. Again, go and watch my liquidity video. So all I'm trying to say is that my next step is to spot the liquidity area in the market. Before I explain further, let me fill you in on why I will want to see a liquidity area close to my supply/demand. One is that if I don't see liquidity resting above my zone might likely be the liquidity area. My second reason is that I want a fast move. I said previously that liquidity is like fuel, so when price gets the fuel it needs, which is by sweeping liquidity, it tends to move fast. So it's either I see a liquidity or wait for price to engineer one before tapping into my zone. But sometimes I do take trades that have all my confluences without liquidity, but I risk very little. The next thing I do is to look for any imbalance or FVG to confirm that my demand zone is valid. Once my FVG is present, I simply check the trading volume to cement everything together. What I do with the trading volume is not rocket science. I simply check if the trading volume bar matches with price movement around my demand zone. If I see much disparities, I simply zoom off, because if price eventually returns to the demand zone, best believe that the zone might break. Once these 6 things are intact, all I do next is sit on my hands and play the waiting game. Honestly, it is not easy waiting for price to come back. Sometimes it might take days for price to come back to the zone, but that is the rule of trading. If you can't wait, you can't trade. When price finally comes back with my A+ setup, I don't hesitate. I take the trade with reckless abandon. Trading is a business of probabilities. There are losing days too. If it hits TP, wonderful, and if it hits SL, no problem. So long as I followed my trading plan, I'm good. It's part of the game. This is another beautiful setup that dished out full TP. I used my A+ setup with Confluence to take this trade. I didn't just blindly enter the trade. I waited for my setup to show up. Trading is very risky, I must be honest, but sticking to your plan is what will help you as a trader. The first thing I had to identify in this trade was the bias. What direction is the trade going? From the market structure, the trade is breaking structure to the upside, which means we are bullish, so I'm only going to long the market. I can't just go and start buying because the market is bullish. I have to look for a good and sweet spot to join the trend. For me to find this sweet spot, I have to look for the recent break of structure. If you notice, the trend started from here, but the high didn't break structure, so I forfeited it. I went to the next break of structure. This break of structure had everything I needed, because it did its job by breaking the previous high, which is this one. If you notice, there is another break of structure, but I didn't bother using it because the move is not as strong and deep as the other one, and secondly, it looks like a trap. It looks like price was trying to engineer liquidity. So I went ahead and traced the origin that caused the break of structure, and I marked the red candle before the move. For me to be very sure of the demand zone I just marked, I looked for an imbalance close to my demand zone. As you see here, price had already started engineering liquidity above. This is a trap by institutional traders to trick traders into early entry. Then I cemented all of this by confirming with trading volume. Seeing that the trading volume and price are in agreement, I then waited for price to come to my zone and entered the trade. Here is the same setup on GBP/JPY, bearish. The market was bearish, so I already know that I'm only selling. I asked myself, since we're selling, where am I selling from? Where do I join the trend? For me to know where I'm going to hop on the trend, I looked for the recent BOS. Not just the most recent, but the most significant. By significant, I mean the one with the strong and deep move. For example, look at these two moves. They're almost the same size in length, but this move has momentum candles. Not just momentum candles, it has fat juice FVG in it. So this type of move that broke structure is the one I'm interested in. So I traced the origin where the move came from. I marked it out as my supply zone. Then I have liquidity resting above my supply zone with fair value gap close to the zone. I turn on my trading volume to confirm everything. The trading volume and price movement matched, so I waited and waited for price to come back. After the long wait, it came back and dished out full TP. Many traders will say that price has two outcomes, which are SL and TP, but I differ a little bit. Price has three outcomes: SL, TP, and price never came back. Sometimes price doesn't come back, but it's once in a while and not something that happens every day. When I see this type of setup, I don't hesitate to take the trade. If the trade is good, it goes to TP, and if not, it goes to SL. No strategy or setup is a holy grail. There are losing days. It doesn't mean that the setup or strategy is wrong. It's just that the market didn't validate my decision. I accept my loss and move on. Okay, that's it for this video. Drop me a like, drop your comments, and please subscribe to my channel, and I'll catch you on my next.